Hello and welcome to this week's weekly wrap. And geez, is there a lot for us to unpack? It definitely hasn't been a week for the faint-hearted on the markets. We saw one of the biggest sell-offs that we've seen in the past couple of years, followed by one of the strongest one-day rallies since 2020. The markets have continued oscillating between some key price levels, and the VIX is remaining elevated above that key 30 level. We got some more U.S CPI inflation data over the past week, and of course all of this is shaping up towards the upcoming FOMC meeting, where we may receive the first interest rate hike of the cycle. This, of course, is all playing out with the backdrop of the continued geopolitical tensions in Europe, the uncertainty about what that could mean, and of course, the economic sanctions that are beginning to flow through. There's plenty for us to discuss. We'll talk about all of this and make sure you stay until the end, because we'll talk about the nickel short squeeze that really captured the market's attention. For now, sit back, enjoy a cup of tea, and hope you enjoy this week's weekly wrap. So as we mentioned, the markets had significant momentum and velocity with both directions moving significantly over this past period. Overall, many of the leading global indexes around the world did finish the week lower. The S&P 500 was down by around 3% for the week, but it did see that significant one-way rally upwards as well as, of course, a major sell-off. We know that many of the leading indices now around the world are into correction territory. Of course, we know that the NASDAQ has actually entered into a bear market from peak to trough. And so there's a lot of uncertainty and the markets really are fearful. If you think back to last week's weekly wrap, we know that the fear and greed index was actually tracking at 21. But as we can see here, it continues to move further and further. The markets get more fearful and uncertainty and more narratives continue to emerge. The volatility index has remained around this key level of 30. This has been quite an important level on the VIX over the past few years, over the longer term time trend. And so it'll be very interesting to see if we can start to see the VIX subside, and then maybe if we start to see volatility ease, whether we can see some more smooth and relaxed times on market. Very keen to know your thoughts on it all too, so drop in a comment below what you've made of this past week on markets, any opportunities or things that you've been looking out for, and then also very interested to know what your thoughts are with the upcoming FOMC meeting and the potential rate hike that's up ahead. So of course, the first thing to discuss here will be the Ukrainian situation. First and foremost, the focus has not changed over this past period. This is first, it's a humanitarian crisis. And then everything else, any economic and market implications that flow through, is a distant secondary to that. I think what has been positive to see over this past period is that humanitarian corridors have begun to open up. And of course, this is important as many people are trying to flee to neighboring countries. But we know that for that backdrop, Kiev has still not yet been captured, the capital. Zelensky has continued putting out his inspiring messages via videos and other mediums, and we know that preliminary discussions between both Russia and Ukraine have commenced, though they've not yielded any results. What has been interesting is a slight movement or a slight pivot in terms of stance, and it looks like Ukraine is open to neutrality. However, they would want security guarantees with that. And of course, we're all familiar and understand that economic sanctions have been applied in a coordinated effort globally. And over this past week, we've seen many leading companies as well, from professional services to retail to everyone in between, slowly starting to actually pull out their operations within Russia. It's going to be interesting to see how this next week unfolds. Of course, it's a very fluid situation that continues to evolve, so we'll keep our eyes on everything that's playing out. And first and foremost, really do hope that there's a safe and swift resolution for everyone involved in the situation. And then another important data point that we had over the past week was the U.S CPI inflation print. It was hot. Is anyone surprised? No, of course not. We know the backdrop. 7.9% year on year, 0.8% month on month. That grew from 0.6% the month before that. And really what this is doing is setting the stage for the upcoming Federal Reserve meeting, which is just days away at the time of this recording. As we know, it's the fastest annual jump since 1982. Really, we haven't seen a hot inflation print this hot for really 40 years. You can see here the visual on the right. Inflation is running hot. And I think what's really interesting or it's worth noting about this situation is this, of course, was the February CPI inflation figures. But the Ukraine situation kicked off at the back end of February. And so a lot of the actual price inflations in terms of energy and, of course, wheat, grain, agriculture, those didn't flow through in that February print. So there is the expectation that the upcoming March print will actually be hotter and have even higher levels of inflation. So that is something to note. And, of course, the Federal Reserve and other central banks around the world will be cognizant of that fact too. And that all leads into the FOMC meeting. It seems like we've been talking about this first rate hike for many months now. The Fed have actually been doing a very good job of telegraphing it, forecasting it. They don't want to take the market by surprise. They want to avoid the taper tantrum and any wobbles that come as a result of this. Though, of course, we do understand that you can't fully avoid them, but with as much warning as possible, they're hoping to avoid the worst of that. And they have been telegraphing this. We know that the upcoming meeting, it's on March 15th and 16th, so it'll be in this week up ahead. Basically, consensus now is that it'll be 25 basis points. We do know there was initial discussions about potentially 50 basis points, but the global macro picture, the uncertainty, the geopolitical tensions has meant that the Fed has a little more optionality and they are able to take a more wait-and-see approach with this. I think it is worth noting as well that observers, analysts, economists, investors, they're not just watching for that first rate hike and expecting the world to change or the macroeconomic picture to change after 25 basis point rise from near zero. What everyone's really watching for is the pathway forward, the wording, the language used, insights about how many rate hikes. Will it be 4, 5, 6 this year? There's significant divergent opinions between many of the leading investment banks and funds. And so the language will be important, as well as any further insights as well surrounding the discussion on quantitative tightening and the unwinding of the balance sheet. It's a formative time. We haven't had rate hikes since the last of the cycle in 2018 when Jerome Powell was raising rates back then. We all know that the back end of 2018 was quite an uncertain and volatile period on markets as well. So we'll be continuing to watch to see the insights that come out of this upcoming FOMC meeting and, of course, how the markets react to it too. And then finishing off with the nickel short squeeze. I mean, you just have a look at that chart there on the right. It is basically a parabolic line upwards. The price of nickel rose to $100,000 a ton. It was a crazy event. It really, really was. Before we talk about the nickel short squeeze, if you have enjoyed this video, don't forget to hit the like button. If you're new here, welcome. We make daily videos each and every day. So make sure you've subscribed, turn your bell notifications on as well. You won't miss any of our daily episodes. So I guess unpacking the story. Nickel. Russia is actually the third largest producer of nickel in the world. So they're a major producer, like many other commodities as well, as we all know has been playing out over this past period. But what's unique about the Russia offering for nickel is that they're a major producer of battery grade, or what's designated as Class 1 nickel. And so this is really, really important. We know that there's been a lot of supply chain fears as well as uncertainties. And so this started to see some uncertainty in terms of the markets because supply chain fears mean that there could be shortage of supply. Of course, we know the consequent effect that could have on prices. There's also a period of higher volatility as well that's unfolding. During periods of high volatility, liquidity reduces. But as liquidity reduces, of course, that can increase volatility with lower liquidity pools. And so as a result of that, we saw positions close. There was a significant spike and then a short squeeze as people who were short on the trade struggled to cover and they clambered. And of course, the price went higher and higher and higher. To give you an insight into the magnitude, nickel has risen by around about $10,000 over the past 5 years. This past week alone, the price of nickel rose by over $70,000. You can see here on the chart, it is unprecedented, it's unparalleled. The LME, the London Metal Exchange, actually closed down trading in nickel. So it's going to be very fascinating to see what happens over this upcoming period. But there is a lot to unpack and to watch moving forward. If you want a deeper dive into the nickel supply-demand dynamics, how it's actually used in around the world and why there's a lot of excitement about nickel as a potential facilitator for the electrification of EVs globally. We did a video unpacking this story and a bit more of a deeper look into the short squeeze. So we'll leave links to those up above you can check out after this one. Thank you so much for joining us. It was an exciting week. I'd love to know your thoughts. Drop in a comment below and we'll catch you on our next video soon. For now, stay well and happy investing.